Melbourne rent prices are 10 to 15% lower than where they need to be. Melbourne's rents are around 10, and this is the research that I've been doing, they're about 10 to 15% off the East Coast. So if I go a similar distance from the city and I look at similar types of properties from the central business district, Melbourne rent prices are 10 to 15% lower than where they need to be. So if you own an investment property in Melbourne, you need to jump onto Moorr and you need to do the asking rental analysis tool that we've got in there. And you need to take that to your property manager and you need to say, I think our rents can go higher. So even if the property manager says, I'm not quite sure, you've got evidence-based data that can support you in terms of making sure that those rents are higher in the Melbourne market. There's no reason why those rents shouldn't be moving at a market rate in terms of what's happening in those areas, especially when you've got 26,000 less rental properties in the Victorian market, thanks to the regulation that's been put into that particular state. That's what we always said. If you throttle the market, the unintended consequences are that rents will go higher. And so you need to start moving those rents higher if you're operating in that Melbourne market. So on the demand side, we've still got APRA driving investors into that affordable market. We don't have any fears of job anxieties like we did last year. We don't have any forced sales. The higher employment story meant that we don't have mortgage in possession sales, which people were talking about the risk. And
so Ben, that's no forced sales through COVID, no forced sales through mortgage cliff, no forced sales through 13.
What about the fixed rate cliff? That everyone, that was 2 years ago now. Time flies, right? 18 months ago, everyone was talking about this fixed rate cliff. Never happened. We were telling you it's not going to happen. It's too widely spread.
Now, no Y2K either. So it's just racking up headlines here that people will just get anxiety around that doesn't need
Follow the logic. Okay, so then we've got household formations. That has definitely made an impact. So we are starting to see when rents are getting more expensive, people are forming sort of a flat share type arrangements. That's all pretty good in terms of adjusting for the demand and the economic mechanisms that happen inside a marketplace. We are going to see a bit of slowing migration and immigration. So I think from that point of view, that's an important story that we need to understand. The government interference, again, obviously the Greens are doing a great job of scaremongering in the rental market. And so ultimately, if they keep doing that, that'll continue to play with market sentiment and potentially impact the people that they are meant to care about, being the renters. The upside story is what we've just talked about. The cost of building new homes is so expensive at the moment. So the supply side is not going to come on quickly. It's certainly not in the next 12 to 18 months, but after that, hopefully it'll start to settle down as that demand for labour and unemployment goes a little bit higher. We'll see those labour costs come down and hopefully some of the material costs come down as well. Then we've got interest rates, which is a good news story for us. Obviously, lower interest rates, when interest rates move by 1%, it usually means about a 6% movement in house prices more globally across the country. Inflation is falling, which is a good news story, and real wages growth is growing at around that sort of 3% range. So that also means that borrowing power is actually meaning that you can borrow a little bit more, and that puts upward pressure on prices over the longer term. So there's a wrap up of some of the demand factors that you'll be looking at. The other things you want to potentially be exploring, as we were talking about, is days on market, stock on market, average vendor discounts. Those types of things are telling part of that demand story, as well as that market cycle timing sort of piece. So I wanted to just wrap up the story by sort of showing you the last 3 years of performance. So remember, properties can, and like any sort of thing, from a demand, supply, and an economics point of view, they can never always be out of equilibrium. At some point in time, they will move back into equilibrium where demand will push and bring up to that particular level, or supply will arrive and bring prices down to an equilibrium. So that's why these cycles only happen in spurts, and it's not a beautiful linear line over the longer term. So how I would wrap that story up in terms of bringing all of those markets into play, one of the things we want to be talking about is, more broadly, we don't think that there's going to be strong price growth across all markets over this 2025 year. We think it hopefully will be a little bit more steady and a bit more sustained as part of that. But again, the market's in market story. We think that the market that will perform well will be the affordable markets based on borrowing power and how the government have got those, macro prudential regulations in place. I think we will start to see in the premium end of the market some growth in those markets that have been flat over a reasonable period of time. So we are on the positive ledger in terms of price growth across most of those particular markets. We think that Hobart will continue to be challenged. We think that Sydney, from an affordability point of view, will continue to be challenged. So we expect continued growth in southeast Queensland. We expect some of the regional centres that are going to have these irrational amateurs playing in them off the back of spruikers will probably be the better performers this year, but it won't be sustainable performance. So we don't, that's trading market, so we won't be touching that. And we put Darwin in that category as well. So even though we think Darwin will be the top 1 or 2 in terms of performing, we've got to think about your strategy. You've got to think about what vehicle you're using to buy those properties in. So for mine, and this is my own personal opinion, this is not advice, if you've got a self-managed super fund and you're looking to trade a market because you only have a 10% capital gain because you're going to sell, this is not a buy-hold strategy, that would be the type of vehicle that I'll be using to go into those types of markets, especially with their attractive yields. But that is not a value play, that is a trading play as part of how we wrap this up.